Thank you for taking the time to join us today despite your busy schedules. My name is Ken Tamagawa, CEO of SORACOM. Today, I will walk you through our financial results for the fiscal year ended March 2025. Let me begin with a summary of today's presentation. For the fiscal year ended March 2025, we achieved steady growth in our key performance indicator, recurring revenue, which increased by 21.9% year over year to 6.56 billion yen. Total sales also recorded strong growth, rising by 13.4% to 8.99 billion yen. Our EBITDA reached 833 million yen, and our GAAP-based operating profit stood at 656 million yen, marking our sixth consecutive year of profitability. In the past, we reported operating profit on a non-GAAP basis, adjusted for factors such as stock-based compensation and goodwill amortization. However, based on feedback from investors who prefer indicators closer to actual cash flow, we have decided to focus on EBITDA going forward. Specifically, we will present EBITDA figures that add back depreciation to our non-GAAP operating profit to provide a clearer picture of our business performance. Looking ahead to the fiscal year ending March 2026, we are introducing a range-based financial forecast. While I will discuss the full details later, for today's overview, I will refer to the midpoint of our forecast range. We expect recurring revenue to increase by 37.9% year over year, with total sales projected to grow by 25.7% and EBITDA by 36.1%. These significant increases are driven by the continued expansion of our global business, as well as the integration of the Marubeni Group's MVNO business. In addition, our transactions with KDDI, which have traditionally been concentrated in the second half of the fiscal year, will now be distributed more evenly across quarters thanks to a new comprehensive agreement. This change will enable us to achieve more stable revenue and profit growth on a quarterly basis. Our growth strategies continue to focus on three main areas, alongside the ongoing expansion of recurring revenue. On the global front, we have established a robust structure that allows us to secure large-scale, long-term projects, such as our recent engagement with Hilton Group, a major international hotel chain. We are also strengthening strategic partnerships in multiple sectors. For example, in the utilities market, we have begun developing next-generation gas meter reading devices in collaboration with the Nichigas Group. Furthermore, together with the Marubeni Group, we are not only launching a new joint venture, but also deepening our strategic collaboration to accelerate IoT adoption, both domestically and internationally. Another important initiative is the integration of generative AI and IoT, what we call the AI of Things. Our service, SORACOM Flux, launched last July, has been very well received by customers. Recently, we have seen successful use cases from companies such as Otsuka Warehouse and Co-op Sapporo, demonstrating the growing adoption of our AIoT solutions. Last fiscal year, we faced the challenge of revising our earnings forecast downward in the third quarter. However, we were able to deliver solid results in the fourth quarter, ultimately achieving our full-year targets. For the fiscal year ending March 2026, we are projecting robust growth, including a 37% increase in recurring revenue. We greatly appreciate your continued support as we pursue these goals. That concludes the summary of today's presentation. Today, I will first present our full-year financial results for the fiscal year ended March 2025. Following that, I will discuss our financial forecast for the fiscal year ending March 2026. Finally, I will provide an update on the progress of our growth strategies. Let me now walk you through the full-year financial results for the fiscal year ended March 2025. Before diving into the numbers, I would like to briefly explain SORACOM's business. SORACOM operates a global IoT platform. We don't just provide IoT connectivity, we offer a comprehensive one-stop solution that includes IoT devices, network communication, and IoT cloud services. Our revenue model reflects this structure. On the left side, we have IoT devices, which generate incremental revenue as customers purchase them repeatedly. In the middle, IoT communication services provide recurring revenue through ongoing data usage fees. On the right, our IoT cloud services also generate recurring revenue via monthly subscription fees. This recurring revenue forms a stable, continuous income stream, which is our business priority. In fact, recurring revenue accounts for a significant portion of our total sales, approximately 70%. Now let me explain the financial figures for the fiscal year ended March 2025. Our key performance indicator, recurring revenue, reached 6.56 billion yen, growing 22% year over year. This demonstrates solid and steady growth. Our annual churn rate remains exceptionally low at just 0.4%, reflecting strong customer retention and a stable recurring revenue base. Next, I would like to compare our actual results with the earnings forecast we revised in February. Thanks to a strong performance in the fourth quarter, we were able to make significant progress and largely meet our targets for recurring revenue, total sales, and operating profit. Specifically, recurring revenue reached 6.56 billion yen, total sales came in at 8.99 billion yen, and EBITDA was 830 million yen, all closely aligned with our revised forecast. This slide shows a comparison of our results with the previous fiscal year. Recurring revenue continued to grow steadily, increasing by 21.9% year over year. The recurring revenue ratio within total sales also remained high at 73.0%. Total sales achieved strong double-digit growth of 13.4% year over year. Gross profit followed a similar trend, rising by 12.0% compared to the previous year, driven by our expanding recurring revenue. On the other hand, SG&A expenses increased by 16.2% year over year, reaching 4.38 billion yen. This increase was primarily due to expenses related to M&A. As a result, operating profit on an EBITDA basis remained flat at 833 million yen. However, on a GAAP basis, operating profit declined by 9.7% year over year to 656 million yen, mainly due to higher stock-based compensation expenses. Despite these challenges, we successfully maintained profitability for the sixth consecutive year. This slide shows the quarterly sales trend for the fiscal year ended March 2025. Fourth quarter performance was exceptional, with total sales reaching 3.29 billion yen, helping us meet our earnings forecast. Recurring revenue grew strongly at 24% compared to Q4 of the previous year. The strong recovery in the fourth quarter was an important achievement for us. Last year, we faced challenges around incremental revenue timing being heavily skewed towards the second half of the fiscal year. To address this, for the fiscal year ending March 2026, we will take a more conservative approach to estimating incremental revenue. We will further prioritize recurring revenue to build a more stable and predictable revenue structure. Next, I would like to explain our earnings forecast for the fiscal year ending March 2026. For the fiscal year ending March 2026, we are presenting a range-based forecast. This approach reflects the variability of our operating environment, including factors such as the progress of customer projects, fluctuations in exchange rates, and synergies from M&A. Let me now walk you through the expected figures for recurring revenue and total sales. The left side shows our recurring revenue forecast of 8.69 to 9.41 billion yen. Using the midpoint, this represents a 38% increase year over year. We expect the ratio of recurring revenue to total sales to remain high, at approximately 80%. On the right, we present the forecast for total sales, which includes both recurring and incremental revenue. We are projecting a strong year-over-year increase of 26%, with total sales estimated to be between 10.8 and 11.8 billion yen. Next, let's take a look at our earnings forecast for the fiscal year ending March 2026 in more detail, starting with gross profit. We are projecting gross profit to increase by 18.2% year over year, reaching between 5.7 and 6.2 billion yen. This represents solid double-digit growth. SG&A expenses are expected to increase by 20.5% compared to the previous year, mainly due to expenses associated with M&A activities. These expenses are estimated to be between 5.1 and 5.45 billion yen. As a result, we anticipate EBITDA to grow by 36.1% year over year, reaching a range of 1.06 to 1.21 billion yen. This figure excludes goodwill amortization and stock-based compensation expenses. For GAAP-based operating profit, we are forecasting a range of 600 to 750 million yen. This would represent a modest increase of 2.8% compared to the previous fiscal year. Now, I would like to explain three key initiatives that are expected to have a significant impact on our earnings forecast for the coming year. These are first, the continued growth of our global sales. Second, our strategic collaboration with the Marubeni Group, both in Japan and internationally. And third, the comprehensive agreement we have concluded with KDDI. In the fiscal year ended March 2025, our global sales reached 3.76 billion yen, representing a 30% increase year over year. We expect to maintain this momentum, aiming for over 30% growth this fiscal year. One of SORACOM's key strengths is that our platform complies with global standards for both communication and cloud services. This allows our customers to deploy IoT solutions in over 185 countries worldwide. Currently, we operate according to a three-base structure: Japan, the United States, and the United Kingdom. Our local teams in these regions are directly engaging with customers and generating an increasing number of successful use cases. To put this into perspective, If we consider the size of the Japanese market as one, the US market is more than 5 times larger, and the European market is over 4 times larger. Given these market dynamics, we see significant room for further growth. In particular, our US team has been performing very well recently, so we will continue prioritizing expansion in the world's largest market. The second initiative is our collaboration with the Marubeni Group. This collaboration has two main components. First, a strategic partnership between Marubeni and SORACOM to promote IoT adoption in Japan and globally. Second, the establishment of a new joint venture company. I will explain the strategic partnership in more detail later. For now, I would like to focus on the new company we are establishing. This slide illustrates the structure of the new company. We will be spinning off the MVNO business from the Marubeni Group, and SORACOM will acquire 51% of the shares, making it a subsidiary. This joint venture will be jointly promoted by both SORACOM and Marubeni, leveraging the strengths of both companies. Let me now explain the aim of establishing the new company with the Marubeni Group. The Marubeni Group's MVNO business has been focused on providing on-premises communication services for people. As a full MVNO of NTT Docomo, it operates its own communication infrastructure to support consumers and mobile workers, and offers a wide range of services, including IoT solutions. In contrast, SORACOM specializes in IoT connectivity for things. We are a full MVNO of KDDI and also operate as a global full MVNO. Our communication infrastructure is software-based and built on the cloud, enabling us to provide a highly functional platform specifically designed for IoT applications. These two businesses are highly complementary. By bringing them together, we'll create strong synergies leveraging both companies' unique strengths. For example, by combining the capabilities of both entities, we will become a multi-carrier full MVNO that supports both NTT Docomo and KDDI networks. This will give us a unique and highly competitive position in Japan. Furthermore, with SORACOM's global operations, we effectively become a triple multi-carrier full MVNO, which is a significant advantage in the IoT field, where network coverage and fault tolerance are critical. Next, I would like to explain the expected impact of making the new company a consolidated subsidiary on our earnings forecast. For clarity, I will use the midpoint of our forecast range. At this stage, we are taking a conservative approach. The figures do not yet include potential synergies and reflect standalone performance. Even so, we expect the new company to contribute 1.29 billion yen to sales and 175 million yen to EBITDA. Although operating profit will be positive on a standalone basis, the impact on consolidated operating profit will be limited due to goodwill amortization. Going forward, we plan to grow both sales and profits by expanding the customer base of the new company and SORACOM, leveraging economies of scale in network infrastructure and enhancing capital efficiency through the integration of SORACOM's software assets and development capabilities. While the gross profit margin and operating profit margin for the group as a whole may temporarily decline due to this consolidation, we expect to improve profitability over the medium to long term by increasing sales, reducing network costs, and optimizing SG&A expenses through synergies. The third initiative supporting our forecast is the comprehensive agreement with KDDI. As shown in the graph on the left, sales to KDDI have historically concentrated in the second half of the fiscal year, causing backloaded operating profit. However, we signed and announced a new comprehensive agreement with KDDI in late March. This agreement allows us to secure orders earlier in the fiscal year, enabling us to distribute revenue and operating profit more evenly across all quarters. Under this comprehensive agreement, we will deepen our collaboration with KDDI in several strategic areas. These include connected car solutions, OEM provision of our advanced mobile core system, and initiatives in the AI of Things, which integrates generative AI with IoT technology. Up to this point, I have explained the key drivers of our strong growth forecast for the fiscal year ending March 2026. The expansion of our global business, the strategic collaboration with the Marubeni Group, and the comprehensive agreement with KDDI. This concludes my explanation of the earnings forecast for the fiscal year ending March 2026. Next, I would like to talk about the progress we are making with our growth strategies. At SORACOM, our growth strategy is firmly built on the foundation of steadily expanding our recurring revenue. Building on this foundation, we are pursuing additional growth opportunities through three key initiatives: expanding our global business, promoting strategic alliances and M&A, and advancing our AI of Things initiatives, which combine generative AI with IoT technology. SORACOM's recurring revenue is supported by a broad customer base of more than 30,000 companies using our IoT platform, SORACOM, across a wide range of industries and applications. Over the years, we have published more than 300 customer case studies, and this accumulated cross-industry knowledge is one of SORACOM's key strengths. One recent example is Safety Shield, a European customer, which uses SORACOM in a system that employs AI to automatically recognize the shapes of people and objects, enabling safer and more efficient operations. Let me now explain how we are driving the sustainable organic growth of recurring revenue. Recurring revenue is essentially the product of two factors. ARPA, which stands for average revenue per account, representing the average monthly fee per customer, and the number of billing accounts, meaning customers with active monthly subscriptions. Looking at the graph on the left, ARPA grew by 10% in the fiscal year ended March 2025. For the current fiscal year, we expect ARPA to continue growing at a rate in the low teens. On the right, we see the trend for the number of billing accounts. This figure also grew by 10% in the previous fiscal year. For the fiscal year ending March 2026, we are taking a slightly conservative approach, forecasting growth of around 8%, as this is the early stage of the fiscal year. By multiplying the respective growth of ARPA and billing accounts, we expect recurring revenue to maintain steady organic growth in the 20% range. Let me now return to the first pillar of our growth strategy, global expansion. As I mentioned earlier, our overseas sales now exceed 40% of total revenue and continue to grow at a strong pace of around 30% year over year. This sustained high growth is made possible by two factors. First, we have established a solid global sales structure. Second, we have proven our ability to continuously acquire large-scale projects in international markets. A recent example is the project we secured with Hilton Group, a leading global hotel chain. Hilton has chosen to deploy SORACOM services across its global operations. This adoption was based on a comprehensive evaluation of SORACOM's service quality, our extensive global coverage, and our solid track record of successful implementations. The project will be rolled out progressively on a global scale. Moving on to the second pillar of our growth strategy, strategic alliances. One key focus is the large and growing energy and utility sector. For example, Nichigas has been using SORACOM's platform for its automatic gas meter, known as Space Hotaru. Today, more than 1.5 million of these devices are already in operation. Building on this success, we have now begun joint development of the next generation gas meter device with Nichigas. The current devices already offer several advanced features. They support multiple communication standards, are optimized for low power consumption, minimize data transmission for cost efficiency, and enable seamless integration with cloud-based business systems. With the next generation devices, we aim to further enhance power efficiency and maintainability, making them even easier to deploy and manage at scale. Another important area we are focusing on is the connected car segment. At MWC, the world's largest mobile industry trade show held in Barcelona this March, we showcased a proof of concept demonstration on next generation network architecture for connected cars. This project is being developed jointly with Toyota Motor Corporation and was exhibited at the booth of AECC, an international automotive industry consortium. Our goal is to develop next-generation connected systems that deliver seamless services worldwide. As a global IoT platform originating from Japan, SORACOM will continue to support the overseas expansion of connected car technologies, leveraging Japan's competitive advantage in this field. Regarding our collaboration with the Marubeni Group, I have already explained the establishment of a new joint venture company. Beyond the joint venture, we're making steady progress in strengthening our strategic partnership with Marubeni, both in Japan and internationally. I will now explain the details of this collaboration as well. This slide provides an overview of our collaboration with the Marubeni Group. Marubeni is a major general trading company with extensive business assets and customer networks, both in Japan and overseas. Their business spans a wide range of industries, including mining, automotive, logistics, energy, water, and agriculture. Through this collaboration, we'll promote IoT solutions by leveraging SORACOM's technology and platform across these industries. Furthermore, by working together with Dolbix Consulting, a Marubeni Group company specializing in consulting services, we plan to offer customers comprehensive support, including business consulting and data analysis. This will accelerate the digital transformation, or DX, of Marubeni's client base. Let me now share more specific examples of our collaboration with Marubeni. In the domestic market, we are working closely with Dolbix to support customers from the initial stages of IoT adoption, all the way through to creating value from data and transforming business models. This end-to-end support includes business consulting, solution implementation, and ongoing support, with a particular focus on industries such as automotive, energy, logistics, and manufacturing. On the international front, we signed a collaboration memorandum of understanding with Marubeni in February. Since then, we have been actively engaging with various Marubeni business units to understand the challenges and needs of each industry. For example, we are exploring IoT solutions to improve safety at mining sites by monitoring the location and vital signs of workers in real time. We are also considering automating data collection processes, such as digitizing the operation data of multifunction printers, which was previously done manually. Additionally, we are developing IoT applications in logistics and solar power generation to improve efficiency and enable data-driven management across Marubeni's global operations. The third pillar of our growth strategy is the integration of generative AI with IoT, which we call the AI of Things. Traditionally, IoT involves collecting data from various devices, storing it, analyzing it to extract insights, sending notifications or alerts, and ultimately controlling devices based on those insights. SORACOM has made it easy to collect data from a wide range of devices. However, until recently, the analysis of this data relied heavily on human involvement. This made it challenging to process the vast amounts of diverse data being generated in real time. Generative AI has changed this dramatically. With its remarkable capabilities, generative AI can now analyze various types of data, including images and videos, making it highly compatible with IoT applications. To lead in this area, we established the IoT and Gen AI Lab in collaboration with the Matsuo Institute of the University of Tokyo. We have been conducting research and development on AI of Things through this initiative. In March, we launched professional services through the IoT Gen AI Lab, and we are already working with several companies, including Mitsubishi Electric, to bring practical AI of Things solutions to market. In July of last year, we launched SORACOM Flux, a service enabling customers to independently build advanced IoT applications quickly and easily. Since its release, the service has attracted a great deal of attention from many customers, and we have continuously enhanced its features. Recent major updates include support for Google's latest generative AI model, Gemini 2.0. We've also added specialized IoT functions, such as location information processing, vibration analysis, as well as sound wave and radio wave analysis. These enhancements enable us to meet a very wide range of customer needs, further expanding the potential of IoT applications. Public use cases of SORACOM Flux have already begun to emerge. One such example is Otsuka Warehouse, which has implemented a system that uses SORACOM Flux to analyze camera images in real time with generative AI, automatically detecting and notifying anomalies. The system captures still images every few minutes from multiple cameras installed in the warehouse. Generative AI then performs anomaly detection on these images. One of the key advantages is the ability to set prompts in natural language, such as, if there is someone not wearing a blue work uniform, notify as a suspicious person. This makes it easy to build and adjust the system as needed. In this case, the system was planned, developed, and launched into a demonstration experiment within just 1 month. The customer also appreciated the flexibility of being able to make changes to the detection criteria simply by modifying natural language prompts during the testing phase. Another notable example is Coop Sapporo. Coop Sapporo had already been working on streamlining operations in their delicatessen sales areas using our cloud-based camera solution, SORACOM. Building on this, they adopted SORACOM Flux to automate image analysis processes that were previously performed manually. For instance, in this project, the system automatically detects and records the quantity of delicatessen items displayed on store shelves. It can also send notifications directly to the company's internal chat system, further improving operational efficiency and reducing manual workload. This concludes my explanation of the progress we have made with the AI of Things. Looking ahead, we will further showcase our advancements at SORACOM Discovery, one of Japan's largest IoT conferences, which we will host again this July. This event attracts over 2,000 participants every year, and we plan to announce new initiatives that combine generative AI with IoT. We are pleased to announce that Mr. Nagasaki, president of OpenAI Japan, will be joining us as a keynote speaker. During his session, we will present our collaborative initiatives with OpenAI, highlighting the future of generative AI in the IoT industry. In addition, Suzuki Motor Corporation and Iris Oyama will also present their latest IoT initiatives, including cutting-edge applications in the automotive sector. We encourage investors to attend and witness SORACOM's leadership in the fields of IoT and generative AI as we continue to drive innovation both in Japan and globally. Up to this point, I have explained our sales growth strategies. Now, I would like to share the progress we are making toward our mid to long-term corporate value enhancement goals. Previously, we announced performance-linked paid stock options to demonstrate our management team's commitment to long-term value creation. Through this initiative, we set specific targets to achieve total sales exceeding 20 billion yen, recurring revenue of more than 14 billion yen, equivalent to 70% of total sales, and to reach a market capitalization of over 150 billion yen at an early stage. Looking at our earnings forecast for the fiscal year ending March 2026, the midpoint of our forecast range projects recurring revenue of 9.05 billion yen and total sales of 11.3 billion yen, showing steady progress toward these goals. At the current pace, we believe it is possible to achieve our recurring revenue target as early as the fiscal year ending March 2028. Although the vesting period for the paid stock options runs until the fiscal year ending March 2030, we are determined to achieve these targets ahead of schedule. While stock prices themselves are beyond our direct control, we will continue to focus on consistently improving our business performance and driving sustainable growth. In addition to sales growth, we are also placing emphasis on profitability. Specifically, we are aiming for an EBITDA margin of over 10% and a profitable growth indicator, the combined total of recurring revenue growth rate and EBITDA margin, exceeding 40%. Let me explain the concept of profitable growth in a bit more detail. Profitable growth is calculated by adding the growth rate of recurring revenue, which represents a stable revenue stream, to the EBITDA margin. The reason we focus on EBITDA margin rather than operating profit margin is that we intend to actively invest in areas such as stock-based compensation to attract top global talent, as well as in inorganic growth through M&A. In the fiscal year ended March 2025, both recurring revenue growth and EBITDA margin saw a temporary decline, resulting in a profitable growth figure of 31.2%. However, for the fiscal year ending March 2026, we anticipate significant improvements. Based on our current forecast, we expect profitable growth to be in the range of 42.2% to 53.7%. Our goal is to maintain a healthy balance between top-line growth and strategic investments, ensuring that we can sustain profitable growth at levels above 40% over the long term. That concludes my explanation of the progress of our growth strategies. At SORACOM, we remain committed to our vision of becoming a global platform originating from Japan. By combining IoT technology with generative AI, we will continue to drive innovation and deliver value to our customers, partners, and shareholders. That concludes my presentation. Thank you very much for your attention.